All right, let's dive into Walmart's latest earnings. This morning, they reported what looked like a pretty solid quarter, but then the stock immediately took a nosedive. So what gives? In this explainer, we're going to break down exactly why a beat on paper didn't turn into a win on Wall Street. Let's get right into it. So at first glance, everything looked great. Adjusted earnings per share, 74 cents. That's a penny ahead of what analysts expected. Revenue, a massive $190.7 billion, just squeaking past the estimates. But then you look at the right side of the screen, the market's reaction. The stock sold off almost 3% before the market even opened. It's a classic case of a beat and drop. And that really is the million-dollar question here, isn't it? If the numbers were decent, what on earth spooked investors so badly? Well, the answer isn't just in the numbers they just reported, it's in what they said is coming next. Okay, so let's start by peeling back the layers here and really digging into the numbers behind that initial negative reaction. You know, what's so interesting here is the size of the beat. I mean, it was razor thin. A 1-cent beat on earnings, a $100 million beat on a revenue number of over $190 billion. For a company the size of a planet like Walmart, that's practically a rounding error. It just wasn't the blowout quarter the market was clearly hoping for. And that brings us to the most important piece of context. You've got to remember Walmart stock had literally just hit a brand new all-time high less than a week before this report. The market had already priced in perfection, which meant that expectations were through the roof. Any tiny little crack was going to look like a canyon. But hold on, before we get to what really caused the drop, it is absolutely critical to understand the powerful engines driving Walmart's business right now. Because, the underlying story here is actually incredibly strong. Let's look at what's really working for them. First off, their digital machine is just firing on all cylinders. Global e-commerce was up a massive 24%. This proves their strategy of blending their physical stores with their online presence isn't just working, it's accelerating. This is not your parents' old brick-and-mortar retailer anymore. Second, and listen, this is a total game changer for their profits, their global advertising business grew by an astounding 37%. Think about it. They're turning all that website traffic and all those people in their stores into a super high-margin digital business. This is a huge mix shift, meaning more of their money is coming from these really profitable areas. And that is exactly what investors love to see. And third, that steady recurring revenue is getting stronger and stronger. Membership fees from things like Sam's Club and Walmart Plus jumped over 15%. This is all about creating a stickier customer who keeps coming back, which in turn creates a much more predictable flow of cash for the company. And get this, it's not just about selling more stuff. The company actually got more profitable. To grow your gross margins even a little bit while you're operating at this kind of massive scale, well, that's just a sign of incredible discipline and execution. So, with that really strong quarter as the backdrop, management spent a good chunk of the call painting a picture of where this giant ship is sailing next. CEO John Furner really boiled their whole strategy down to this one quote. See, they get it. Modern retail isn't just about who has the lowest price. It's about saving people time and making their lives easier. Every dollar they invest in technology is built around this core idea. And they didn't just talk about it. They showed the receipts. The number of people using their fast delivery options exploded by 60%. Shoppers who use their Sparky AI assistant, they're spending 35% more, on average. And to show just how confident they are, they're giving a ton of cash back to shareholders. A huge new $30 billion buyback plan, that's about 6% of the whole company, and another dividend increase. They are seriously putting their money where their mouth is. Okay, so we've got a solid quarter. We've got powerful growth engines and a super clear vision. So why the heck did the stock drop? Well, this brings us to the main event, the part of the show that really mattered, the guidance. And here it is. This is the slide that caused all the anxiety before the market opened. The full-year earnings guidance, while it looks okay, just wasn't as good as the bullish whisper numbers. You know, those unofficial expectations that get passed around on Wall Street. When your stock is trading at an all-time high, even a pretty good outlook can feel like a big letdown if it doesn't beat those whispers. And this right here is the key takeaway from that initial stock drop. In today's market, which is always looking ahead, what you say you're going to do is often way more important than what you just did. And for Walmart, that conservative outlook simply drowned out the solid quarter they just delivered. But here's the twist, and this is what the savvy investors started to pick up on during the actual call. Management basically dropped hints that, hey, we have a history of being pretty conservative with our guidance. This was a signal to the market that this could be a classic under-promise so we can over-deliver situation. And that's a big reason why the stock started to climb back later in the day. All right, so let's tie this all together. What does all this mean for the stock going forward? Where does it go from here? Here's the official Talk Ticker's verdict. Okay, for their next quarterly report, we fully expect Walmart to come in at the high end of their guidance, all powered by that same amazing digital momentum. For the stock price, expect some choppy waters in the short term as the market figures out this high valuation. But remember that massive $30 billion buyback? That acts as a huge safety net under the stock. So putting it all together, we're initiating coverage with a market perform rating. Look, the company is executing beautifully, but at this price, a lot of that good news is already baked in, and their conservative outlook is probably going to limit the upside for now. And as always, please remember, this is not financial advice.